Most HMRC horror stories don't actually start with fraud. They start with a missed form, a wrong code, or a system error that nobody noticed. And before you know it, your business is staring down a colossal bill for £225,000. Unfortunately, this sort of scenario isn't rare. Every week, my team and I have to fight to protect our clients from overstatements, ridiculous penalties, and automated charges like this. So in this video, I'm going to show you exactly how to protect your business from being wiped out by an error that won't even be your fault. First of all, here's the brutal truth. HMRC doesn't wait to be right. It acts first, asks questions later. Their system isn't designed for fairness, it's designed to collect fast. Most people think there's someone at HMRC manually checking returns, maybe in a grey cardigan, sipping tea, reviewing your case line by line. Yeah? Sorry. No. HMRC runs on automation. If a return's missing, a box is misticked, or a number looks odd, the system does not wait. It calculates a bill and starts enforcement. No hesitation, no mercy, no biscuits. Here's what that can mean. Penalty points for missing VAT or CIS returns stack up like nectar points, except these ones cost you money. Interest kicks in from day one, even if your payment's only fashionably late. Tax determinations, HMRC just makes a number up for you, usually based on your very optimistic figures at registration. Direct recovery of debt. Yep, they can literally dip into your bank account without a court order, like a financial ninja. But it gets even messier if you don't catch it earlier. Let me show you how fast things can spiral. We had a client whose bill ballooned from 20,000 to over 200,000, and it all started with a software glitch. By the time they spotted it, the bill had gone from 20,000 to over 200,000 due to a cascade of charges, estimated assessments, and compounding interest. And the worst part, they had no idea anything was wrong until they opened the laptop, logged in, and saw a massive unexpected payment sitting there pending, just waiting to go out. So this video isn't about avoiding tax, it's about not waking up to a six-figure bill you didn't see coming and having to fight your way back. Now, here's where it starts for so many business owners. You register for VAT and that's the trap. Because from that moment on, HMRC expects flawless records, timely returns, and accurate payments every quarter. No excuses. But most small business owners are never actually taught how to manage VAT properly. And VAT rules, they're complex. They change constantly. Just one innocent mistake, a missed return, a wrong rate, a late payment can trigger automated penalties before you even realize something's wrong. HMRC's system does not ask questions. It doesn't send a friendly nudge. It assumes you're wrong until you prove otherwise. Let's break this into two stages: before you register for VAT and after you're in, because both are full of traps. So stage one, before you register. Most people think VAT deadlines are based on the tax year, but that's actually not the case. The VAT threshold is 90,000 in any rolling 12-month period. Not your tax year, not your calendar year. Rolling. This means you could hit the threshold in October, for example, without realizing it. You won't get a warning though, and if you only check in April, you're already 6 months late. And here's the kicker: HMRC doesn't need to tell you. They're legally allowed to wait years before sending a notice. And when they do, they backdate it. So what actually happens? Well, your VAT registration is backdated to the month you should have registered. You then owe VAT on every sale since that date, even if you didn't charge your customers. Plus, you can't go back and add VAT unless you re-invoice, which is awkward and sometimes impossible if you're selling to retail customers. And it doesn't stop there. Interest is added from the original due date, and penalties start at 15% and they can go higher if HMRC thinks it was deliberate. For example, one director we worked with, he crossed the threshold in September and he didn't spot it until the following May. By then he owed nearly £17,000 in uncollected VAT, plus interest, plus penalties, and all because he thought it reset at the end of his financial year. Stage 2, after you register. Let's say you did register on time. You're submitting your returns, you're using cloud software, you're safe, right? Well, not exactly. And in a second, I'll show you the reclaim mistake that triggered a 5-figure penalty for one of our clients. Even when you registered, VAT is full of hidden landmines. And one of the biggest, reclaiming VAT on things you're not allowed to. And that includes things like client entertainment, lunches don't count, company cars, unless you meet very specific rules. Mixed use items like phones or fuel, unless properly apportioned. Your accounting software might let you reclaim it, but if HMRC reviews it later, you're liable, not the software. One director we worked with had a good year, so he did what many of us would. He started taking clients out, nice lunches, football matches, even a Christmas do. Every receipt went into the system. The VAT was reclaimed automatically by the software. No questions asked. Fast forward 18 months, HMRC runs a routine check, and here's the problem. Client entertainment is almost always blocked for VAT reclaims. The software didn't flag it. The bookkeeper assumed it was fine, but HMRC, they don't do assumptions. They disallowed all the entertainment reclaims going back 4 years. That free lunch turned into a £9,000 VAT repayment plus interest. So here's what we recommend. Track your turnover monthly. Set an alert at 85,000. Use software that flags reverse charge and import VAT. Double check reclaim rules for cars, phones and entertainment. File every return, even if you can't pay. And if you're unsure, get help before submitting, because with VAT, even small errors snowball fast. If this is opening your eyes to how easily VAT can go wrong, subscribe. We break down HMRC traps like this every week in plain English without the scare tactics. It's free, it's practical, and it'll save you more than it costs. And if it stops being useful, you can unsubscribe faster than HMRC sends penalty letters. Let's be blunt, payroll mistakes don't just cause admin headaches, they can trigger backdated PAYE bills, 15% employers NIC, penalties of up to 30%, and even a full-blown employer compliance review. And here's the kicker, you might not even know there's a problem until months later. And unlike that, which gets reviewed quarterly, payroll errors often go unnoticed for months. And by the time HMRC catches it, you're already knee-deep in late filing fines, NIC underpayments, or worse, trying to convince a computer you don't owe money you never earned. Even if you do use payroll software, the system's only as good as what goes in. All it takes is the wrong tax code applied to a new employee, a missing starter declaration, or misclassifying a director as an apprentice, and boom, your streamlined payroll turns into a liability time bomb. And sometimes the error doesn't even come from you, it comes from HMRC. And these errors, they're not just theoretical. Here's what happens when it goes wrong. One of our clients had a £200 payroll charge appear on their account for a month they never even ran payroll for. Didn't owe a penny, still got the letter. So they did what any reasonable person would do. They called HMRC. They were held on for hours. They were reassured it would clear automatically and then got another demand letter 2 weeks later. It's like arguing with a sat-nav that insists you're in Belgium when you're clearly in Basingstoke. And it gets worse. Another client, their employee's record got duplicated. Same job, same salary, but HMRC's system showed 40,000 salary, instead of 20,000. Try explaining that one to a computer. There were letters, calls, and meanwhile the employee's tax code was wrecked, their take-home pay plummeted, and morale followed. Here's why you should take care. You can do everything right, submit on time, pay accurately, and still get penalized because of bad data inside HMRC systems. And when those systems get it wrong, you're the one who has to prove it, not the other way round. This stuff matters, and it's not just about staff on payroll. If you're hiring contractors or are one, these mismatches can wreck your tax position too, because if HMRC thinks someone's actually inside IR35, meaning they're acting like an employee even though they'll invoice through a company, they come knocking with a very expensive clipboard. And here's what they can demand: backdated PAYE and employee NIC, 15% employers NIC, interest and penalties up to 30%. And they'll go after whoever they believe should have known better. So that could be you or it could be a client. So what triggers IR35 suspicion? Well, things like no substitution clause in the contract, fixed monthly payments, bit like a salary. The client controls your hours or tools, or you've only got one long-term client, or your email signature has their logo on it and not yours. Feel like a business? Brilliant. But if on paper you look like Janet from accounts, same hours, same desk, same box, HMRC won't care how entrepreneurial you feel. Quick check-in. If any of that's sounding familiar, pause now, comment IR35 below if you're not sure where you stand. I'll point you to the right resource, because these problems are 100% avoidable. Just remember, check. CHECK. Check your payroll every month. C, codes and categories. Always double check new starter details. One bad NI letter or tax code can mess up payroll for months. H, HMRC ready. Reports. Don't wait for year end. Don't wait for the panic. Review your reports every month and catch mistakes early. E, employment status reviews. If you're hiring freelancers or contractors, run regular IR35 checks. Don't rely on the contract alone. How you work matters more. C, control and clients. Keep proof that you're independent. Multiple clients, your own kit, control over your time. It's all your defense if HMRC starts sniffing. And K, keep it smart with software. Ditch spreadsheets. Good payroll software flags anomalies before they become liabilities. So we've talked about IR35 and payroll, both of which can quietly blow up behind the scenes. Now let's talk about corporation tax. Sounds deceptively simple, right? One return once a year, no monthly submissions, no rolling thresholds. What's the catch? Well, when it goes wrong, it goes big, because by the time you realize there's a mistake, you're already months past your year end. HMRC are no longer nudging you, they're issuing penalties. And every error, missed relief, or misreported figure, that's money you can't reinvest. You can't draw it as dividends. You can't use it to pay yourself. It's not just admin, it's your working capital gone. Even small errors in your CT 600 can cost you thousands. Not because HMRC is out to get you, but because the system is rigid. Misreport a figure, you might overpay and wait months for a refund. Miss a deadline, relief denied, interest charged, letters incoming. Guess on expenses. That's how personal spending gets flagged. And here's where people trip up all the time. They think that if it's related to the business, they can claim it. HMRC says, not so fast. Here are the usual suspects that get flagged. Clothing, only okay if protective or clearly branded. Entertainment, meals, drinks, client hospitality. Home office, must be properly apportioned. And phones, laptops and cars, only the business bit claimed. And if HMRC decides an expense is personal, it often gets shoved into your director's loan balance. And here's the kicker: if that loan isn't repaid within 9 months after your year end, the company owes a whopping 33.75% tax on it, locked in until you pay it back. So how do you avoid this? Cross-check every expense. Don't guess. Verify. Separate personal versus business use. Claim only the business portion of things like cars, for example. Don't trust software defaults. Review everything. Submit early. Leave time to fix any mistakes. If you've ever been surprised by a corporation tax bill, hit like and stick around. We've got more tax traps coming that'll save you thousands. Now, you think corporation tax is risky? Just wait until you're dealing with property, shares or construction, because this is where HMRC really sharpens the claws, because the rules get stricter, the sums get bigger and the penalties are even less forgiving. If you're selling assets or working in construction, you're playing in HMRC's favourite audit zones, and one wrong step can lead to huge backdated bills, denied reliefs or even accusations of tax avoidance. That's where CIS and capital gains tax often catch businesses out. Both have really strict deadlines, low thresholds for error and absolutely no grace period. Let's start with CIS, the construction industry scheme. If you're a contractor or subcontractor, CIS is your world and the rules are brutal. One slip, automatic fines. Now, if you're a contractor, HMRC is watching you even more closely. Miss a step under the CIS scheme and you're opening the door to fines, even if you didn't pay anyone that month. Here's what you must get right every single time. Verify every new contractor with HMRC before paying them. Don't assume their status. Deduct the correct CIS tax rate. It's 20% if verified, 30% if not. Submit your CIS return every month. Even if you had no subbies that month, you've still got to submit one. Pay the deducted tax to HMRC on time or face automatic penalties. Miss just one return, that's £100. Miss 4, you're £400 down. Still nothing to report? HMRC does not care. File anyway. These aren't admin fines. They're real money off your bottom line. And for smaller contractors, that could mean the difference between paying yourself this month or not. We've seen contractors wait 12 months, yes, literally a full year, for CIS refunds, all because one return was late. And it gets worse. In one recent case, a contractor realised they'd been paying subcontractors gross, but still sending HMRC 20% as if it had been deducted. When they flagged the error, HMRC initially said the overpayments would be refunded, but weeks passed and nothing. Instead, HMRC set up a £225,000 direct debit against their account while the repayment stayed in limbo. Imagine losing access to nearly £250,000 because the system couldn't reconcile a reporting mistake. The business owner told us it takes 2 full-time staff and a chartered accountant just to stay compliant between CIS, reverse charge VAT and trying to decode which jobs actually fall under which scheme. It's like playing a game where the rules change every month and missing one move costs you thousands. And if you're a subcontractor, if your contractor messes up their side, you wait. Overclaim on expenses, trigger a review. Miss your tax return, penalties and refund delays. So whether you're a contractor or a subby, this isn't just admin, this is survival. Now, onto capital gains tax on property. If you're selling a buy-to-let or a commercial unit, you've got 60 days from completion to calculate the gain, report it and pay the CGT. Miss that, £100 fine. 6 months late, another £300. 12 months, add another 300 plus interest, currently 7.75%. Sell a flat, forget to report and realise 6 months later, you're down 1 missed return, 1 late payment, 1 £600 penalty and interest on a £20,000 gain, all because you didn't know it had to be filed separately from your self-assessment. And here's the brutal part. That 600 doesn't just sting, it wipes out your buffer. Money that you could have used for a tax bill, a software upgrade, or paying yourself that extra bit in dividends. Gone. Not because you traded recklessly, but because you missed a form. And don't forget, the CGT allowance was slashed to £3,000 from April 2024, so even modest gains are now taxable where they weren't before. If you want to stay out of trouble, here's your cheat sheet. For CIS, submit CIS returns every month, even if you paid no one. Use software that flags submission deadlines. Verify every new subby before first payment. Keep clean records, gross fee net paid, UTRs, deduction statements. For capital gains, know the 60-day rule. It applies even if you don't owe much tax. File a report online through the CGT on UK Property Service and get help early if you're unsure. Remember, this is in addition and separate to your year-end tax return. Now, it might sound like a lot, but getting this right can save you thousands in fines, delays and stress. If you're ever unsure, don't wait for a brown envelope from HMRC. Reach out, get clarity and protect your cash. Hit like if this saved you stress and subscribe for more ways to dodge disasters and keep more of what you earn. So, let's take a step back. We've covered the specific mistakes, missed registrations, filing errors, expense claims, timing issues, all the ways things can quietly go wrong behind the scenes. But what happens when you miss several things or just don't respond? That's when HMRC stops playing nice and starts bringing out the big guns. Think less polite letters and more financial SWAT team. We're talking debt collectors, frozen bank accounts, and direct recovery straight from your business funds, all triggered because of a filing mistake or missed payment. These are HMRC's escalation powers, tools that let them take your money, guess what you owe, and act before you even get a say. Since 2015, HMRC has had the legal power to access your business or personal bank accounts and collect unpaid tax without a court order. It's called direct recovery of debt, and it works like this. You owe tax. You've ignored reminders or haven't agreed a payment plan. HMRC checks your bank balance. If there's enough to pay the debt, they'll freeze it. You're notified after the fact and the money is transferred. Sounds extreme? It is, and it's all perfectly legal. And if you've got a direct debit set up, that payment will be scheduled to go out automatically even if the amount is incorrect. We've seen cases where companies spotted 5 or 6 figure collections queued up after an error, and HMRC's advice is simply let it happen, claim a refund. That stops the money from leaving your account while the issue is being investigated. The key is to act before the collection date, because once the payment's gone, the system assumes the debt is settled and getting it back can take weeks or longer. This system does not care if it's fair, only if it's paid. If you don't act fast, you'll be cleaning up the mess after the money's already gone. Now, we've covered a lot. What HMRC systems are looking for, the deadlines that trigger penalties, and the common mistakes that spiral fast. So now you know what to watch out for. But honestly, because the real stress saver, it's not tax knowledge, it's backup. It's having someone in your corner who lives and breathes this stuff, who understands how HMRC escalates things, who knows when you can challenge a penalty and how, and who can get on the phone to HMRC so you don't have to. Because HMRC's system is automated, but fixing it, that takes real conversations, real negotiation, real strategy. You shouldn't have to become a tax expert just to protect your business. And the worst time to learn all this is when it's already gone wrong. Remember that letter I showed you at the start? That business avoided a six-figure disaster because they acted early, not when HMRC was already knocking. So if anything in this video felt a bit too familiar, or if there's a brown envelope on your desk you've been ignoring, this is your nudge. Don't wait, ask for help. Talk to someone you trust before HMRC decides for you. See you next time.